Hello, this is Tony Brown Pendergraft with the Pendergraft firm, and I'm here with my colleague and esteemed peer, Sakinah Tillman. And can you tell them more about yourself?
Well, hi, everyone. My name is Sakinah Tillman. I am a tax attorney licensed in the state of Maryland. I am admitted to practice in the United States Tax Court. So what that means is that I'm able to represent people all over with their federal tax issues.
All right, great. And how can people reach you?
You can actually reach me on Instagram at Tillman LLC. I have all of my information there about my firm. And you can actually look at my tax videos as I talk about different tax issues on my Tillman Tax Tips on Tuesdays.
All right, great. So Tuesdays, starting on Tuesdays. So we're gonna have a link to the I guess her Instagram and even the Tillman tax video. So I put a Tillman tax video down there too, so you guys can see it yourself. So it's going to be down in the description. You guys already know how to reach me. So that said, let's get into why Sakinah is here with me today. So today's video is on questions real property owners probably shouldn't ask, but we're going to answer them anyway. So here is, I guess, why I am, why we're doing this video anyway. So a landlord reached out to me and he asked me questions like, how likely is it for what are the consequences of a landlord not reporting their rental income? Or how likely is it for a landlord to be audited? Or questions like that. Now, again, although I guess I am a landlord attorney, I am not a tax attorney. So that is why my tax attorney colleague is here. But I do know enough to know that those are probably very bad questions that you probably shouldn't be asking. But I give the people what they want. So we're going to answer those questions anyway. That's why I brought the expert here on. So I guess we can I can get into the questions, or is there anything you'd like to add to that?
No, we can just get into the questions.
All righty. We're going to those questions we probably shouldn't ask. I'm going there. All right. Ask these taboo questions. She's going to hate them, but we're going to get it done. All right. So the first question is, what are the consequences of a landlord not reporting their rental income?
I think you have to start with the premise is that under the Internal Revenue Code, Section 61, you have to report all income that you receive. Failure to report income in the event that your return is selected for audit, then the IRS will request all of your information to determine that your tax documents substantiate what's reported on the tax return. Most importantly, if you are a landlord and you're receiving income from your tenants, whether it's by check or by cash, the IRS says that, well, not the IRS, but the Bank Secrecy Act says that there's deposits of $10,000 or more, it must be reported to the IRS. So as a consequence, if you had those type of deposits and you're not recording that on your tax return, the IRS will already have note of these deposits and want to make sure that it's reported on your tax return. If not, you can get audited and they can make adjustments to your tax return and determine how much taxes you should be responsible for. So the answer to the question, as a brief synopsis, is that failure to not report your income, you can be a target for audit.
Okay. That pretty much brings us to the next question, actually, is being a target for an audit. So how that's actually one of the questions that this landlord asked me. So how likely is it for the IRS to find out, or how likely is it for the IRS to find out about your your tax avoidance or your misdeeds and to want to audit you? Or how likely is that?
Well, less than 20% of taxpayers get audited. However, your return has to show some type of red flag. But the disadvantage, if you're a landlord, if you're not reporting your income, that's going to be a disadvantage to you because you're able to report so many expenses that you pay for throughout the year. So not reporting that income, but you have expenses, it's not helping from a tax aspect. But back to your question is that if the IRS receives your return and there's some red flags, they'll send you a notice saying that, hey, we realize something doesn't look right. For substantiation purposes, please send us whatever documents they may need. And if you cannot prove these documents are true, then they can make changes to your return and your tax liability will most likely increase. And you not only have to pay the taxes, but if you're not paying them on time, now you have to deal with interest and penalties.
Okay, so I can save money by trying not to avoid.
Exactly. If you had the right tax attorney or the right accountant or tax attorney can help you with saving and making sure that you're budgeting properly for your business.
Okay, got it. So that's probably another reason why these questions are bad. So instead of, maybe this is going about it completely the wrong way. So if I was, I guess, trying to be, I guess, a good taxpayer, or give Uncle Sam his dues, and that can actually, I guess, save me money rather than trying to not report at all, because now I'm not writing off expenses, essentially.
Exactly. And I think that's the biggest thing with business owners, whether you are someone that owns a law firm, a dry cleaner, or even a landlord, is understanding what you can actually deduct. And I think with business owners, they had this idea that, hey, I have all of this money, I have to report it. I'm going to have to pay taxes on the money that I receive. But you're really paying taxes on your net profit. It's your total amount that you receive subtracted by your expenses. That's how you get to net profit. But it's understanding what can actually be deducted. And I think most business owners, they miss out on a lot of expenses because they're not thoroughly educated. That's why I always recommend that you hire a tax professional to help you understand what is considered income. Most importantly, what is considered expenses.
Okay, got it. Yeah, so it sounds like we may need to talk after this. So
Sure.
help me out. I'm pretty sure that I'm, missing out on a lot of things with my own business. I spend a lot of time working at home. Maybe I can, write off my
Exactly.
bills and stuff. Things I'm not doing right now that I probably should be doing.
Exactly.
Let's see. And I think you were saying earlier something about it. So there's a 20% chance of someone
About a 20% chance.
getting off.
But I, as a tax professional, I always tell my clients to do the right thing.
Okay, so we don't want to. Again, these are. I'm supposed to ask bad questions right now, right?
Exactly.
You know what I'm saying? Someone out here listening may want to take that 20% chance. We don't advise you to do that, but again, the whole concept of this video is, these bad questions.
But let me add something. I think it's important to understand is that if you are that risk taker taxpayer and you're going to say, hey, I'm going to just take this risk and I'm not going to quote unquote report all of my income for this year or maybe subsequent years. What you have to understand is that the IRS has a collection statute expiration date. And what that means is that the IRS has 10 years from the date that the return was processed to collect any additional taxes that may be owed. So in other words, if you filed a 2018 tax return and you quote unquote did not report all your income, the IRS can come back 2 years or 3 years from now and say, hey, I would like to examine this return more thoroughly and I want X amount of documents to substantiate what you actually reported on the return. So although they may not get you now, they may get you later. So be mindful of that before you make these type of decisions.
So if I can make it 11 years, then I'm good.
If you can. But as a tax professional, my goal is to give you advice. I have ethics rules that I have to follow. So I would never tell someone, hey, do not report this. The goal is to report everything that you have. And we can talk about strategy. That's the most important thing.
All right. Got it. All right. So, and let's see, another bad question I can ask you. So what does a red flag look like? I think you were saying something like,
Sure.
You see a red flag. And so granted, what would I guess pop out to someone that's like this is an obvious red flag, like that requires examination. Maybe they haven't prepared it themselves and you use a professional. Maybe it's less likely to look like a red flag if, professional did their returns, or if they're doing it themselves, or
I can tell you a lot of things. For one, whenever I prepare someone's tax return, I always look at the previous 3 years.
Mm-hmm.
That gives me an idea of, how much they may receive in a refund, if they're entitled to a refund, and then what type of tax liability in their income that they reported. And I compare it to the current year that they're giving me. And one of the biggest red flags that I see is that on the itemized deduction, known as Schedule A, in the gifts and charitable portion, that number is most likely inflated, meaning that that number is either a number that someone cannot substantiate. So in other words, the report that they gave $20,000 to their church or $30,000. What that number does is that there's a standard deduction that everyone has based on their filing status. Those itemized deductions are eligible expenses that a taxpayer can claim. One is charitable contributions. Another is your state and local taxes, like real property taxes, your income taxes that you paid, as well as your mortgage interest that is deductible.
Okay.
So if those values exceed your standard deduction, what that does is it helps lower your income that's subject to tax. So the actual gifts to charity, there's no cap on that. So if you have $30,000, that's exactly what's going to be reported. And what I find is that when I look at returns, that number is always inflated. To the extent that it's lowering someone's income to the point where they're able to now get a refund or their taxes are now lower because of that. That's a red flag. And so when the IRS sees that, whether you're a business owner or you're a W-2, the IRS sees that, that's a red flag saying, hey, let me ask this taxpayer for additional information to substantiate that. If you are a business owner, another red flag is that when you keep having losses, and usually the first 3 years, your business may encounter a loss contingent upon the type of business that you may have. However, but if you're having $10,000 losses, $20,000 losses, or you have a Schedule C where you have no income reported, or there's a small amount, but you have huge expenses, that can raise a red flag to the IRS.
See, I'm at a few red flags then.
Right.
We'll see.
And if you are a landlord and you have rental property and you're reporting Schedule E, the same principle applies where you have your expenses tremendously exceed your income for the year. That can raise a red flag because the IRS wants to know, I understand that you may have a loss for your business, but why is this loss so huge? And they want to do further investigation because the goal is to make sure that people are paying their taxes. And the IRS, they want to make sure that no one is evading to pay taxes because invasion is an intent. And there's a lot of taxpayers out there that evade paying taxes.
Right. So I'm asking these questions anyway.
Right.
So, you bad person out. Well, I guess I'm a bad person, but bad taxpayer for sure.
Exactly.
But I guess what you're saying, it actually kind of moves us on to our to our next question. Actually, when you're asking about, I guess when you're talking about landlords and having rental properties or like a second, third property essentially. But what about, let's say a landlord is doing this with their let's say they're not reporting on their primary, like let's say they have a primary home that they reside in and that they are renting out, I guess, that primary home that they live in themselves. So I guess the IRS doesn't know that they have a second, well, there is no second rental property. Say they're just renting out their own home. I think they call this house hacking. I think that's the real estate lingo, or they call it house hacking. That's when you stay in your own place and let's say you rent out your basement, right? So you got tenants in your basement. So would that, I guess, increase or decrease the likelihood of an audit?
Well, that is.
And let's say, sorry about that. And let's say that they, you didn't tell them. They don't know that you have tenants in this scenario. They don't know. You just have, I guess, as far as the outside observer knows, you're just living in your place and you don't have tenants in your basement downstairs. So that said, does that increase or decrease like the likelihood of? It's funny. I know you probably hate the question.
Well, your question it points to several things. The first thing is when you come to a tax professional. For me, I give a tax checklist to help the client gather all their information. And as a tax preparer, we're only reporting what we receive. And it's very important to ask very specific questions. As it relates to a business basement, from a state and tax local standpoint, it depends on your actual county. So why I'm saying this, because some counties require that if you're going to rent out your basement, then you need to have some type of permit. I know the city of Baltimore, they require you to have a permit to get permission to rent that out.
Mhm.
I'm not too sure about Prince George's County.
They do.
And I know for District of Columbia, they had that as well. So by those things being on the books, and let's say you get audited, the IRS can easily contact the state and contact your municipality and say, hey, can you verify that there's no additional income that this person has received? And if they realize that, hey, something is not right, what the IRS can do, they can do a deposit analysis. They can look at your bank account and see if there's any strange deposits that are not out of the ordinary and use that as income. So as it relates to the basement apartment, it really depends. I just think that it's best that you report what you receive.
Right, got it. Now,
but it's hard to say, well, how do you know if the IRS knows that you have this basement apartment? It just goes back to, let's say you never reported, but your county requires you to have some type of permit and you get audited, the IRS can reach out to the state to see if there's additional information.
Got it.
And then after that, you will have to show proof of this rental income. If you can't show proof, then the IRS can try to go through your bank accounts and do a deposit analysis and determine if there's any unordinary deposit and use it as income. So the question is, it really depends. It's no straight answer.
Got it. Understood. Okay. Let's see. Next question was, I actually need to answer. I may be able to answer this question, but can the IRS determine when it's not reporting rental income from a routine audit? I guess the answer to that would be yes, right?
Yes, and then it depends on if that person had a Schedule E in the previous year. So, for example, let's say that 2018, you did not have a Schedule E. Schedule E is for rental property, or if you have a partnership, you report that income on the Schedule E page 2 for partnerships. And let's say that for 2018, you do not have a Schedule E, but you have it for prior year. Mm-hmm. The IRS may say, hey, is this schedule missing or there's no rental property? And that can raise a red flag for you to get audited.
Got it. Understood. And the last question is I asked this question. This is my question, actually.
Okay.
So how can tax attorneys such as yourself help landlords on their taxes and I guess avoid getting audited?
I think the most important thing is to provide them with guidance. Make sure they understand what's reported, make sure they're organized. Most important thing, making sure they have a business bank account. What I see with most landlords is that their rental income goes into their personal account, and that is a no-no because you should not commingle funds. Secondly, making sure that they know what they're doing from a legal standpoint. If they're making any type of transaction, what is the tax benefit or what's the tax consequence? And only a tax attorney and some accountants can help you with that. So I think that's important. And making sure that you hire a professional to prepare your tax returns. I see so many people, mainly landlords or other business owners, that try to do it themselves. And they are being at a disadvantage, not only to their self, but to their business.
And I think that's pretty much it. I think it's all of the questions. So, are there, in fact, the last question would be, is there any questions that I should have asked you? I know that may be a weird question, but was there like a better question to ask, or other than I guess these bad questions? I guess it would be like what would be an example of perhaps a good question to ask? I don't know. I think we pretty much covered everything. I guess the last question was pretty good, wasn't it?
Right. I think a good question for any business owner and even landlords is to, one, figure out the type of expenses that you may have. Two, another good question to ask is that know where your actual rental properties are located. In other words, the actual city, county, and see if there's any type of tax credits that you can apply for to reduce your real property tax bill. Baltimore City has a ton of tax credits, real property tax credits, to help business owners reduce their tax liability. Or one, if you're considering new construction and you're going to consider renting out, whether it's an apartment building or whatnot, figuring out what tax credits are eligible for you that you're able to get. Just understanding those things to help you as a better business owner, and then making sure that you're able to keep your business growing. One of the biggest things is that when you are not on top of your taxes and you're not paying your taxes on time, that can affect your business, because what happens is that you're receiving all this income, and then when you decide to pay taxes, you may be paying taxes not only for the current year and then for previous years. Now you may be at a deficit because now you're trying to catch up. So the goal is to just be current and pay the taxes every year that they're due.
Right. And if someone gets, I guess, in that bad situation where they have to, let's say they get caught up and now they're in that situation that you just described, they can contact you and you can help them get out of that too, right?
Absolutely. My goal is to help clients with their tax problems and help them get out of the big mess that they got themselves into.
All right, great. So if you ask questions like this video, you end up getting yourself into a mess because of them, you know exactly who to contact. My colleague here, Ms. Sakinah Tillman. And I'd like to thank you for being here. And I guess we'll go ahead and sign out. And again, I'll links in the description of how to contact her.
Take care.
Bye.